So we have spent over 40 years with a front row seat to see firsthand the challenges facing today's retirees. Now, as a result of what we've learned, we have made it our mission to earn your trust by providing open and clear communication, objective advice, hard work, and a genuine concern for your overall financial well-being. So my name is Fred Bowie, and joining us today, we have actuary and author Fred Vettese to discuss his latest book, and it's called Retirement Income for Life, Getting More Without Saving More. So that's a very interesting title, Fred. So welcome, and hope your day is going well, and really look forward to having this discussion, for our group today with you. We'll start off, Fred, by asking, what really inspired you to write this book, Retirement Income for Life, Getting More Without Saving More?
I recall being in a conference of an actuarial conference about 4 years ago. And the conference was being given by a couple of actuaries who happened to be from Morneau-Chapelle. It was on the whole issue of decumulation, which still isn't an official word in the dictionary, but decumulation being the opposite of accumulation. And it was all about how one should be drawing down one's money in retirement. So anyways, as I listened to it, I realized a few things. First of all, I realized that I hadn't given this very much thought before. I also realized that actuaries in general hadn't thought about it, and also that we didn't agree on what are the basic principles as to how this ought to be done best. So it occurred to me that there was actually a book in this, and moreover, it's a book that really hadn't been written as far as I could make out. The vast majority of retirement books out there are on accumulation or on saving for retirement and the whole gamut. They might cover a little bit about the actual retirement period, but I wanted a book that just focused on the retirement period. So this was for people from age 50 and on.
Oh, that's interesting. The decumulation, I just call it kind of income planning, but the new buzzword is that decumulation. And when I started in the business in 1980, I was right into the decumulation because I've always worked with retirees. So it was important to know about income planning. And the transition from accumulation to decumulation is very difficult sometimes for the, let's say, average consumer, for the client to understand, because they're so used to socking the money away, and now in retirement, they're taking it out. So the book is great timing. The baby boomers are approaching that retirement age. I'm 65. I turned 65 in August. So the book is of interest to me, even though I've been in the business for 40 years, but it was a really interesting read. But who should read this book?
This book would be for pretty much anybody who's kind of approaching retirement. I say approaching it, they might be in their 50s. They might not actually plan to retire for another 5 or 7 or even 10 years, but it's coming up. So they can actually see the end goal in sight. It also for people who have already retired and are in the early stages of their retirement. They might be 65 or 67, 70, and this will help correct some things that they may be doing wrong or not doing as efficiently as possible. So it's for that whole gamut of people. Frankly, it's not really for people who are 30 or 40 for the most part, but it does a lot more important by the time people get to 50.
Right. So people are preparing for retirement, for that decumulation closer within a 10-year period, and after that too. What I find is over time, what's happened is people convert, for example, their RRSPs to a RRIF, typically a RRIF, and then to follow up with the potential client, and you say, well, we can provide you advice in the income area, the RRIFs, the annuities. Oh no, mine's all done, right? And so what they do is they do it, and then they never review it. And then they get surprises along the line. So it's important that people in the income phase or approaching that income phase and currently in the phase, that they really read up on material like this and seek out an advisor that specializes in it,
I should add, To that, the other criterion is also, these are people who have savings. They have money, lump sum amounts. As you say, it might be an RRSP or a RRIF that they need to turn into income in some way or shape or form. If they haven't saved in their lives because they were always low income and are going to be relying on old age security and Canada pension plan, it's not really for them. And if they are relying almost entirely on defined benefit pension plans, like in the public sector, it would also be less useful for them as well. But it would really be for people who've been saving money in RRSPs, TFSAs, and now need to turn that into income.
Right. And it's unfortunate that society, we're headed towards a defined contribution pension plan or no pension plan whatsoever. Defined benefit was a great, and of course in the Ottawa area here, it's the superannuation, we call it. And, that's a great plan that's in place for those employees. So no worries in the public sector, because most of the public sector, of course, have a defined benefit plan, but the defined contribution plans are much more popular now, but they're harder to deal with, right? So now, what did you learn from writing this book?
Learned a bunch of things. The great thing about when I write a book, at least, the great thing for me is that it's not as if I know in advance what the whole message is going to be. It's only a matter of putting it on paper. I play a lot with spreadsheets, and I come up with a few aha moments as I'm going through it. And so where I end up at the very end is something I can't always predict at the beginning of the book. So I do have some surprises along the way. This book was no different from that. I did learn things along the way. Some of the more important things I learned was, first of all, the importance for the middle income group. These are people who are earning, say, high 5 figures these days, low 6 figures. The importance for them of Canada Pension Plan and old age security. You might think, well, those are almost incidental. It's really all about their savings, but those are actually very substantial amounts, and how they shape those will help shape their overall income. So that's one thing I learned. The other thing I learned is that you can make your overall income a lot more definite, a lot more predictable than you might think would be the case. Because I can understand if you were relying only on savings, one of your biggest nightmares would be running out of money, say you're at the age of 80, and then what do you do for the rest of your life? So I found that you can actually alleviate that to a large extent, that kind of thing.
And that's important because, I mean, even a RRIF is designed to run out of money. Just depends on what age. And if you're fortunate enough to have that longevity, like my mom's going to be 95 in January. Well, you want to make sure that you're continuing your income well beyond the age of 90. So it is often mentioned in the financial community that as a general rule that retirees need about 70% of their pre-retirement spending once they retire. But of course, every person and every family is unique when it comes to their needs and their wants. Is there a more robust approach to estimating the amount that people will spend in retirement?
Well, first of all, I want to point out that with this book, Retirement Income for Life, I'm assuming people are kind of at the end of their accumulation phase. So they've saved what they've saved, and it's going to produce whatever income it produces. And yes, I'm trying to make it a bit more efficient to produce a bit more certain income than the otherwise might. But otherwise it is what it is. And so that becomes a moot question at that point. If you're actually at the point of retirement, a lot more important of a question when you're, say, 30 or 40 or 50 and trying to plan, well, how much money am I going to need at retirement? Having said all that, I don't actually agree with the 70% rule in general. And I'm working on book number 4 right now. It's the prequel called Retirement Saving for Life. Okay. And this prequel, I deal with that issue very explicitly with a very detailed example, very much as based on real life as I possibly can. Like I actually take actual mortgage rates, actual child costs based on the Ernst & Young spreadsheet and everything else, just to show that it can't be 70% for your average household. By average household, I mean somebody who's bought a house as opposed to renting. Right. And the majority of people who are saving for retirement have bought a house. People who actually have some children as opposed to not having children. For people like that, it can't be 70%. And I prove that in some detail in the newest book. Is there a better rule? Well, if you want to come down with just one number, I would say like 55% would be, you'd be much closer to the target, but it's not really like one size fits all. You actually can devise some examples where 70% is the right number. Somebody who's rented their whole life and never had children. You can also devise examples where 40% is the right number, based upon how much house people have bought and how much they've been paying toward a mortgage and so on, that kind of stuff. But basically, as I said, there really is no one size fits all. But if you had to come down to one number, I would probably make it 55%.
Right. And I think that's realistic. And, you know, unless you're traveling every month and playing golf every day and so on and so forth, your expenses go up. But otherwise, I mean, your expenses really come down in retirement. And I'm actually even noticing that just during the COVID, not that I'm retired, but I noticed that our expenses are way down because we're just not going out as much, you know, can't go to restaurants and can't travel and so on and so forth. So, you know, we wouldn't require 70% of my income at this point if I was retired. So, but in your book, you do discuss these spending shocks. And what do you consider a spending shock in retirement?
Well, a spending shock is something outside of your regular spending. Your regular spending would be things like you need to get, you have to pay your property taxes, you have to pay for a car insurance, house insurance, you have to maintain your car. Those would be your normal kind of, that would be your normal spending. So it might be a shock when you add up the bill at the end of the month, but that is not what I call a spending shock. That's something that you couldn't foresee. For example, you get very sick in your late 70s, and as a result of which you need to have personal support workers coming to your house every day for the course of 6 months, and that can be fairly expensive. So that would be the kind of thing I would see as being a shock. You end up having a major repair in your house that you hadn't foreseen. So a renovation isn't a shock because you can control it. Well, maybe I don't know how it is in your household with your wife, but in theory, one can control that. But you can't control if you need a major repair, like your roof caves in or somewhere there's major flooding going on, which isn't covered by insurance.
Right. So those spending shocks we have to prepare for as well. And I think you make a suggestion of putting a certain percentage aside to pay for those spending shock bills. And now Canadians approaching retirement, the retirement date can be nervous. And today, rightly so, with all the volatility in the financial markets, sequence of returns, especially the first 5 years before retirement and the 5 years following a person's retirement date, plays an important role in determining whether their retirement is a financial success or a disappointing bust. What can pre-retirees do to deal with the worst case investment outcomes? What can they really do, you know, in that first 5 years approaching retirement?
You bring up a good point. You look at some past periods. One of the worst was the stock market crash of 1973-74, which, by the way, was actually worse in terms of percentage losses than 2008, 2009. And during that crash, so if you had been heavily invested in equities as you were going into retirement, then you would have gotten hit pretty hard. And the thing is, you know, you might do fine in the long term, but I think it was John Maynard Keynes who once said, in the long term, we're all dead. We may not have enough time to actually recover from a loss, a devastating loss like that, or like what happened in 2008, 2009. So the obvious thing you can do, obviously, is to reduce your equity exposure. But that's become a real challenge these days because in the old days, you reduce your equity exposure, you load up then on bonds, might be government bonds, and you're still getting a real return over and above inflation of 3 or 4%. You're not getting that anymore. As a matter of fact, if you buy real return bonds these days, the return is actually negative. It's like a negative 1/4 or 1% right now at the present time. So it's become much more of a challenge. This generation of retirees is going to be much more challenged to retire well than has ever been the case.
Right, and especially with those interest rates. I mean, I've lived through, and you have lived through a bounce in interest rates from 18% and down to, like you say, it's basically negative right now. And but even at that time, back in the 80s when you could get, I remember in 1981, you could get 17% on 10-year money at Manulife. And then Standard Life came out, and a lot of the insurance companies and the banks, of course, in the banks, nobody would invest beyond 5 years, but because the insurance coverage is different with life insurance companies, they were offering rates in those deferred annuities, like 20-year rates of 12.75%, 10%. But those are long gone and seem to have started after 1993. Banks in 1993 really started to promote the mutual funds. And a lot of people thought mutual funds, and especially getting them from the bank, for example, that they were fully guaranteed or covered under CDIC. So there's a lot of confusion there. And but it is very, you have to be very creative today, especially in this decumulation that you're entering. So when it comes to, I'm sorry.
What's happening, of course, is we have a search for yield, for return of some sort. How do we actually get that? And at a time when bonds really aren't giving us any yield at all. If you went to a bank now and put your money in GICs or into a so-called high interest savings account, you're only going to get 0.6, 0.7%, maybe as much as 1% if you lock in your money for a long period of time. But this is in an era where inflation is still close to 2%, so you're actually falling behind. So that doesn't really do it. There are some things you can do. One of them is you can defer, and I'm sure you're going to get to this eventually, but you can defer Canada Pension Plan benefits until age 70. Now, when the CPP works out how much, because you get much more money if you start at 70 than if you start at 65, right, and much more again than if you start at 60. So how they actually work out how much more money you get, it's based on actuarial factors. And implicit in all that, underlying all those factors, is a return of 6%. So effectively, when you defer your CPP until age 70, you're essentially getting a guaranteed return of 6% during that period of time.
Right.
It's not obvious to when you look at it, but that is actually what's happening. So it's hard to pass up 6% guaranteed return when the government's otherwise only offering you 1% on bonds.
So if you don't require the income, it's definitely one of your best investments. It's to, it's like my cash value. I'm noticing my cash value life insurance. I'm actually making a lot more money in my cash value life insurance,
right,
than I would in the GIC or in a lot of cases in the market. But it's deferring it somehow, deferring CPP income or deferring OAS. And we're going to talk about that, but people have a hard time, wrapping their heads around that. But if you don't require the income, then your best investment is going to be, from an income perspective, is going to be to delay, if you can, actually both of those items. So when it comes to RRSPs, the government sets the rules and can change the rules, and sometimes to the benefit of the retirees and sometimes to the detriment of the retiree. So eventually we have to make decisions regarding our RRSPs, and those decisions must come before the end of the year that we turn 71. So currently the government offers the options of cashing out, converting to income in the form of an annuity or a RRIF, and has introduced a new option called the Advanced Life Deferred Annuity, ALDA. So the short acronym is ALDA. So now, why did the government introduce this option, and how does it work?
I think they introduced the option because some experts said that we need this option. Mm-hmm. So how does it, and maybe we'll see whether we need it when I explain how it works. It means that with an ALDA, you can actually start receiving your annuity payments at age 85, as opposed to receiving it at the point of retirement. So before you couldn't do this. Before you couldn't defer it past age 71, as you were saying. You have to take out an immediate annuity if you put your money at age 71 or put your money into a RRIF. But now you can defer it until age 85 without any tax consequences. Before there would have been tax, and the tax consequences were a non-starter. In other words, you're paying tax on money you haven't even gotten yet, and no one wanted to do that. They've always had this in the U.S., although there in the U.S. You can defer until age 80. So the advantage of this would be if you're really afraid that you're not going to have enough income or any income when you're 85 years of age because you live longer than you thought you were going to live, then you now have a source of income at that point in time that'll last you the rest of your life. So that would be one advantage. The other advantage to it is that the cost of it should be fairly low. And I say should be because you're discounting for interest and mortality, I guess, from your current age. Let's say you buy it at 65 until age 85. So you're discounting for interest at 20 years. All that means is that you're paying a lot less for it now because you're not going to get it for 20 more years. And so the cost would look to be fairly cheap. So that is a challenge these days because interest rates are so low that it's not as much cheaper as we would have liked getting it. I actually thought this was going to be a really good idea until I did the modeling. As I said, sometimes when I do the modeling on my spreadsheets, I come up with surprises. And I found I really couldn't find a really good scenario for this kind of product, at least not for your average case, for somebody middle income who just wants to plan their affairs properly. If they do the other things I mentioned in the book, i.e. Buying an annuity with a portion of the money that starts immediately, and also deferring Canada Pension Plan until age 71, that they're actually much better off than if they buy this ALDA starting at age 85. And the reason I say that is because when I did the modeling, I find they end up having too much income at age 85 and over. And you say, well, how can you have too much income? You can have too much income if it means you don't have enough now. So they would be struggling now at age 65 or so, in order to get more income than they might need at age 85. So I don't think it's going to be a big success for that reason. There might be some special situations where people actually do have some disposable money now, and they just want to have that insurance policy. They want to have that guarantee that if they do live like to an age 95 or 100 like their mother did, that they will have some income.
Yeah, these new products and introducing. Sometimes I have a concern about RRIFs in general, because when I started in business, the RRIFs were available because they started in 1978. Nobody, or very few people actually entered into a RRIF at that time because you could only have one and you could only take the minimum income. So it wasn't until 1986, and interest rates were pretty favorable in 1986, of course, and then the government changed the rules and said, okay, listen, you can have more than one RRIF and you can take more than the minimum income. So they became very popular then. And people kind of rushed to them and got away from the life annuities, for example. That option was the most popular. But after 1986, it started to lose its popularity. But yet, that's income that people get regularly. A lot of people don't understand that they get pension-like income. Their pensions are considered basically life annuities. So, and I've never seen anybody say, I hate my pension check coming in on the 26th of the month. It's just bothered me because it's an annuity, where the annuity was really one of the, in my opinion, it's one of the best income products, and it's going to fit into a lot of situations, but not 100%. So when I say, wow, get some annuity income, and have that guarantee, I'm not talking 100% of your RRSP money, for example, or non-registered money either, but perhaps 20 to 40% may do it. It'll replace the bonds in your portfolio. So the bonds, they act like a AAA bond, the annuity income. So, guaranteed income for life, good returns, considering looking for those longevity credits down the road. It's an interesting option that people, I think, really should, take a closer look at. But a combination.
I agree totally on that point. They act even better than AAA bonds because there's something called the mortality credit in there as well. In other words, the insurance company takes into account that some people will die at 70, some will die at 75, and so on when they price the annuity. So if you're not one of those people dying early, you're going to get more money than you would have gotten from a bond as a result of it, i.e. the mortality credit. I can agree with you more. I think some of your money, and 20 to 40% is the range I've come up with as well. You don't want to make it less than 20 because then it's hardly worthwhile. You don't want to make it more than 40 because then you're losing too much flexibility. But then in that range, it ends up being a really nice tool and a nice piece in the overall decumulation puzzle.
Right, and that's what it is. It's an overall piece, so it's a planning opportunity for people. But a lot of people don't take advantage of the planning, taking a serious look. They just see a rule, say, listen, I have to deal with this by the time I'm 71. I'm going to move my RRSP to a RRIF. I'm going to deal, with a seg fund or a mutual fund, or I'm going to keep it in my individual stocks. But they don't look any further. They just think, whatever I have in the RRSP now, that's what I'm going to have create my income in the RRIF. And that can pose some real problems down the road where you're running out of money, and or you're worried about running out of money up to the point. And if you, because, I had somebody say to me that they were 71 years old, and they went to a calculator. I think it was a life expectancy calculator that the government has on one of their websites. And he put in there his particulars. He liked to drink alcohol. He used to smoke, blah, blah, blah. He put that in, and it came up and it says, your life expectancy is 76. You know what I mean? So the average life expectancy, 76. Now, what does that mean? Does that mean at 76, half of the people that are 71 with those conditions are still going to be alive? And half are going to be dead? You're an actuary.
Well, it wouldn't be, at average age, wouldn't be 76. It would be more like 81 these days. But if you have certain conditions, like you were just mentioning, smoking, previous smoking and so on, let's say for people in that cohort, it was 76. That just is an average. It means that some people will live until 90 and some will live until 70, but you take an average of all those ages and it'll average out to 76. Mm-hmm. And that's kind of like what life expectancy is. So these days, as I said, if you're 65 and you're normal in terms of your health, and let's say you were not a previous smoker, if you're a male and you're currently 65, you can expect to live until about 85, 86. And if you're a woman, maybe 89. So those would be, and what that age means is that half the people will live longer, and half the people will live shorter.
Right. Okay. And that's what I was trying to explain to him, that he says, well, no, like in his mind, all these people are going to be dead at age 76. Well, no, half of them are. So are you willing to take that chance? Which half are you going to be in? I always say, listen, I never met anybody that died at the right time. I never met anybody that died at the right time. And of course, in Ontario, evidently, the death rate is still 100%.
Yeah, that's right.
So it hasn't changed.
Yeah.
But it's interesting how people view things. But I think it's important that they get advice. And when I say advice, I'm not saying from their brother-in-law or their sister-in-law, or their third cousin twice removed. That they should get proper advice from people that know that people like you pick up the book, people like me, hands-on. So it's always interesting dealing with people. I'm sure they're saying the same thing about me. It's always interesting dealing with people like you, Fred. So another common rule for retirees is 4% spending rule, that 4% spending rule. So that you can safely spend 4% of your portfolio in the first year and adjust for inflation thereafter, and basically not run out of money and income. Now, considering low interest rates and volatile markets, is 4% a reasonable spending rule for retirees?
I think the answer to that question is no, for just the reasons you mentioned, the low interest rates especially. Back in the we don't even have to go back to the 80s, but back in the 1990s, real returns on bonds were 4%. So you could actually just have a portfolio of bonds and expect to have a real after inflation return of 4% per year. And so that 4% rule would have worked out okay. But I used that 4% rule in this book for a couple to show that they can get themselves in serious trouble. And so in my book, my couple, using the 4% rule, end up having a bad investment scenario. I used a Monte Carlo simulation to come up with a scenario. And there was a chance in 20 of coming up with it. You might say, well, it's only a chance in 20, but these things happen, just like 2008, 2009 happened. And what happened earlier back in March of this year happens. These kind of things do happen. And so under that scenario, they actually were essentially destitute, or at least ran out of their savings by the time they were 80, 81.
Right.
So the 4% rule doesn't work if you're in a low interest rate environment, and especially if stocks don't do well. And there always can be a period of 2 or 3 years when stocks don't do well.
Right. And the income must continue. So you have to make a contingency for that. But the 4%, I think in general, as you say, does not work in today's environment. And we're going to be, a lot of people say we're in a low interest rate environment, which we agree that we are in a low interest rate environment. But I don't say that low interest rate environment. I say we're in a new interest rate environment. I do not expect interest rates to increase that much over my lifetime. And I'm saying over the next 30 years, I don't know if I'll live that long, but I don't expect interest rates to rise for anytime soon, like in Japan, with the markets and the interest rates there. So it's very difficult to predict. So it's much better to have guaranteed protected income, right? Or at least a portion of
I'm almost convinced that interest rates will not rise for a long period of time. And that's because of the reason as to why they're as low as they are. Some people might think interest rates are so low because we had the 2008, 2009 global financial meltdown. And so they had to introduce quantitative easing to keep interest rates low. And then, of course, we had COVID. And once again, they had to bring interest rates down very low in order to keep the economy moving along. And that's the reason. But just you wait, once things go back to normal again, whatever normal is, then interest rates are going to go back up again to historical averages. I don't think that is the situation. Those things might have accelerated what was going to happen otherwise. And I think the reason for this phenomenon is almost entirely demographics. Younger people tend to be borrowers and older people tend to be savers. And the population has reached a tipping point where we have more older people than younger people over 50. And as I said, it's older people who have money and they want to get a yield on their money or a return on their money. But it's the law of supply and demand. When you have too much of a supply, in this case, supply of money, and not enough demand, in the case of borrowing by younger people, what happens? Well, interest rates start dropping. Right. And this phenomenon started in Japan 30 years ago, which we used to think Japan was just different from everyone else, but they were just first because they had an older population. Right. Then it moved on to Europe, and then it moved to Canada, and it's moving to the US. And guess what? It's even going to be moving to China in the next decade. So it'll be a global phenomenon, and it'll be around with us for the next 20, 30 years at least. So I don't see any scenario in which interest rates can go very much higher than they are.
Right. And then, of course, it creates a lot of problems, and people should really seek out that advice. And so we're certainly in agreement with that. What is the most important advice? Well, actually, first I want to talk about, with your assistant, you had assistance from Morneau Chappelle's IT team. You developed a unique software program to help retirees plan their income. So please tell us a little bit more about this program called PERC. It's a great name.
Yeah.
The acronym, Personal Enhanced Retirement Calculator.
I'll tell you what happened. I had practically finished writing my book, Retirement Income for Life, 3 years ago. But then it was highly unsatisfying for me because I realized I hadn't really given people any useful guidelines as to how much money they could spend in retirement. I mean, I had my hypothetical couple in the book spend the right amount because I worked out my spreadsheets, but I wasn't giving the reader a way to calculate it. So I put the whole book on hold for several months as I tried to figure this out. And I created a spreadsheet that enabled them to do this. And then I had to make the spreadsheet user-friendly and accessible. And that's when I had the help of Morneau Chappelle to do that. So you can go online the URL is in the book. I think it's perk.morneauchappelle.com. And if you go online to that site, then you simply fill in the fields. And there are a couple of pages of information that you have to fill in because it's complicated. And this is a fairly robust tool. You can't just put in one piece of data and get a good answer. So I try to make it fairly specific to individuals. So you fill in this data, and then it gives you 3 answers. It tells you how much income you can produce without the enhancements I talk about in the book. and then how much you can produce with the enhancements, but a bad investment scenario. And finally, if you have with the enhancements and a reasonable investment scenario. This ends up giving you some real insight into how much money you can comfortably spend in retirement. Great thing about the tool is I really don't like tools where you have to give them your email address and other information, and you may be getting a sales call as a result, or you get put on someone's mailing list. You don't have to enter any email address or give any other personal information in order to use the tool. And so there's no obligation for it. And why I did it is because, as I said, otherwise the book really wasn't practical. You wouldn't have been able to actually exercise the principles that I lay out in the book.
Right, and it's a great site because I went to the site and played with it for a bit, and it's a great site for pre-retirees and retirees to go to. But in particular, those pre-retirees, because it's important that they do this income planning going in as best as they can going in. I mean, nothing is ever perfect, but you'll want to, people will want to plan, especially their livelihood, their income in retirement when they're not getting that regular work paycheck. So we will provide the, number one, they can get that link through your book, purchase the book, or we will provide it at the end of this presentation as well. So we'll put it in. It's a great tool. Actually one of the best that I've seen. People are always looking for, income planners, and this is a great income planner that you and Morna.
Well, thank you. This is actually the second iteration. In the first iteration, I didn't really allow for people to still have ongoing income for a few more years because, as I say, this is the tool for people at the point of retirement. But it's interesting in my own personal life. Whenever I had a friend or an acquaintance ask me for advice and to apply the principles, they were almost in the category of not yet retired. They maybe not retiring for another 3 or 5 years, and they wanted to figure out, what they should do. So I had to allow for that in the tool. So it actually allows you to have ongoing regular employment income for another 10 years before you retire. And that ends up being useful because then you can see how you can still fix things if you need to save a lot more money in order to retire with the kind of income you want to retire with.
Right. It's a tool that you can revisit because, life changes, right? So if we have, some of those spending shocks all of a sudden that we didn't account for, we can start plugging them in and see how that's going to change our scenario and how our income. So it's something that people or advisors should actually sit down and go through with their clients and their prospective clients, and at least once a year, if the client's up to it. And but it's a great tool to continuously use going forward, so that you're always on track. It's planning is so important to stay on track. But what is, Fred, the most important advice you can offer Canadians who are about to retire or currently retired? What's the best advice you can give them?
Well, we've actually just hit on it with PERP. The best advice I can give them is get a really good idea, either through an advisor or through using tools like PERP. Get a really good idea as to how much money you can comfortably spend. I think there are a lot of people out there who aren't spending as much as they could because they just don't know what they don't know. Mm-hmm. And there's a lot of people, so there are some people who are spending more than they should. So they have people in both categories, and it's almost a fluke if they're spending the right amount in retirement. So I would say get a good handle on that, either through using a tool like PERP or through a financial advisor.
Mm-hmm. Great. Now in the book, Retirement Income for Life, Getting More Without Saving More, you introduce 5 enhancements that retirees may consider to enhance their income strategy and help make their money, last a lifetime, even if their investment returns are poor. So the 5 enhancements are: number 1, reduce fees; number 2, transfer risk to government; 3, transfer even more risk; 4, knowing how much income to draw; and 5, of course, have a backup plan. Now, Fred, your book is to the point. It's concise, it's clear, and it's a must read, I think, for every Canadian considering retirement or currently retired. I can't express that enough, that the currently retired should be reviewing on an ongoing basis, just because, a lot of times too, even with younger people, they're not paying attention. You say, how are you accumulating now? Well, RRSPs. I use a TFSA, I use RRSPs. And what is your RRSP invested in? Well, it's an RRSP. Many people don't even know what it's invested in. So, and the same thing when it comes to the income, Now, you have RRIF income and you have an income concern, and you say, well, what do you invest in? Well, in a RRIF. Well, do you own a life annuity? And what kind of pension income you get? So on and so forth. Well, no, I have that RRIF. I have a RRIF. Okay, what is your RRIF invested in? Well, it's a RRIF. I don't know. But at any rate, so we want to get people on that planning train and on that track and try and keep them on track so that they don't get the major shock of having not enough income. So I think it's a read for every Canadian, to tell you the truth. And it's not only a game changer, but it really could be considered a life changer for many people. I think your book goes that far. It's straightforward. It's simple. It's an easy read. It's very, very informative. So I would really encourage people to get a copy. I'll show you.
Thanks very much.
Again, retirement income, getting more. I love getting more without saving more, right? Now, most financial people won't like that, right? Because
well, the original title was the Decumulation Playbook, and everyone asked me, what does decumulation mean? So I changed it.
Right.
Yeah.
No, and it makes a lot of sense. Like I say, it's to the point. So you're really a down-to-earth kind of guy, right? So retirement income for life, getting more without saving more. Where can you purchase the book?
You can buy it in Chapters Indigo stores and also in independent bookstores, as well as Amazon.ca. Mm-hmm. So those are all places where you can buy it, and just do the search for retirement income for life, or obviously in actual bricks and mortar stores. Mm-hmm. It's going to be available October 20th.
Right. So it'll be available on October 20th, 2020. And we're really looking forward to that. I was fortunate enough to get an advance copy, of course. And like I say, I really enjoyed it. So thank you for taking the time with us today, Fred.
It's my pleasure.
And hopefully we can get back to discuss some other issues, long-term care, reverse mortgages, and other topics from your book that we didn't talk about today. So there's a lot to planning. And it can be boring at sometimes, but I think you kind of bring it to life, being straightforward and simple, and there it is, right? So so I really want to thank you for taking the time today to do this interview. And now I'm going to say to the public there, want a copy of Fred Vettese's book for free, one for free, Retirement Income for Life, Getting More Without Saving More. So keep watching the message, the video here, and I'll have a short message on how you can get the book for free. So again, thank you very much for
thank you.
Taking the time today.
Bye.
Take care. Thank you for watching the Fred Vettese interview. If you are retired or about to be, then Fred's book, Retirement Income for Life, Getting More Without Saving More, is a must read. Now, we are giving away 10 free books, and here's how to win a completely revised and updated edition of Fred's book. It's simple. Just send me an email to fred@bowiecanhelp.com, and in the subject line, type Retirement Income for Life. All entrants will be notified of the winning entries. Thanks for participating, and good luck. Again, email me, fred@bowiecanhelp.com, with the words Retirement Income for Life in the subject line. Take care and have a fantastic day.